In this video, I will give you an example which covers bond valuation methods, the calculations of coupon rates, maturity duration, as well as the restructuring of financial position, profit of tax, earnings per share, so on and so forth. Then I will comment on the change in the value of bond before and after the new issuance, as well as the impacts on relevant stakeholders. I'd prefer the calculation process to the discussion and comments, as the financial figures and the process of calculations will speak for themselves, which will definitely make the financial comments more convincing and easier to understand. I will cover all required questions, but not necessarily following the order. So, let's go straight to the points. I'd like to give you 10 minutes for you to familiarize yourself with the situation we are going to encounter. Before I continue, I would assume you paused and have taken time to read through. So here we go. To begin with, I will show you how to make the bond valuation in an effective and efficient fashion by using Excel spreadsheet. Given the financial information of the government bond, the yield curve, and the yield spreads, which are as shown in the context, it's like this. Let's input them into the spreadsheet. It's worthwhile to point out that it's incorrect to assume that bonds of the same risk class, which are redeemed on different dates, would have the same required rate of return or yield. In fact, it's evident that the markets demand different annual returns or yields on bonds with different lengths of time before their redemption or maturity, even where the bonds are of the same risk class. This is known as the term structure of interest rates and is represented by the spot yield curve. So we will take the different spreadsheets into consideration. Provided that before the new bond is introduced, the credit rating is A, and thereafter it's downgraded to B, we will need to add up the government bond and the yield spread of different credit ratings to get the corresponding spot yields of different risk class. So the spreadsheet will the yield curve will be as it's also given that the non-current liabilities consist solely of 5.2 coupon bonds with a face value of 100 each, which are redeemable at their face value in 3 years' time. And these bonds are currently trading at 107.8 per 100. The bond's covenant stipulates that should the company's borrowing increase, the coupon payable on these bonds will increase by 37 basis points. So the coupon for the current bonds after credit rating downgrade will be 5.2 plus 0.37, which equals 5.57. So let's then discount the coupons and the par value in 3 years. You pay attention to the calculation I'm doing. Okay, good. Yeah, but we were told that the current bond will be redeemed in 3 years. So here, actually, at the end of the 3rd year, it should be like this. Yeah. So we have already discounted all the future cash flows, and then we will get the bonds value. Yeah, that's it. It's already indicated that currently the bonds are trading at 107.8. Actually, even if we are not told the information, we can figure it out ourselves. I'll show you how to do it. Also discount with the interest and the repayment. It's 5.2, which is the coupon. Because at the end of the 3rd year, the par value will be redeemed. So here we will plus 100. So the present value of the future cash flows will be we will need to when we round it up, it's that's exactly what we were told. It's trading at 107.8. I'll highlight it. Okay. From the calculations and the figures, we see the value of the current bond after credit rating um, changed from A to triple B does not change very much at all. Why? This is because the increase in the coupons, in this case, it's from 5.2 to 5.57, and the increase of 37 base points, and the resultant increase in value almost matches the fall in value from the higher spot yield rates. It's kind of a compensation mechanism works. It's also asked to calculate the coupon rate required for the new bond. Yeah. As requested by the CFO in the context. So it's already known that the new bond is based on the interest payable annually and face value repayment, and it's a 5-year term bond. So let's calculate the coupon by using the bond valuation method. The discounted coupon and the par value of the bond will be its face value. Or make the calculation by using spreadsheet. So it would be like this. So yeah, we'll get the coupon in 5 years, during 5 years, and coupon. And the repayment at the end of the 5th year at par value. Yeah, the coupon will be so the coupon will be 3.567. Now let's go ahead with the next requirement, the Macaulay duration of the new bond, based on two scenarios. The scenario one is interest payable annually and the face value repayment. Scenario two is the bond based on the fixed annual repayment of the interest and capital. So before the calculation, I'd like you to understand that Macaulay duration is the average time to receive all cash flows, which are coupons and the principal. It's primarily a measure of interest rates risk. The longer the duration, the more sensitive the bond is to interest rates changes. So let's deal with the first scenario, that the bond is based on the interest payable annually and the face value repayment. So it's the average, weighted average time to receive all the cash flows. For the first 4 years, there are only coupon received. Sorry, yes, because the coupon is fixed. So here we go. And the last year we will get both the coupon and also the par value. So it's 100 plus. So let's sum them up. Divided by the total present value. So the duration is 4.66. I will highlight it. Mathematically, the Macaulay duration is the present value of each of a bond's cash flows multiply that present value by the time period of the cash flow, and then sum these weighted present values, and then divide the result by the bond's total present value. You can take a look of my calculation and have a clear understanding of my narratives. Yeah, the first cash flow. Multiply the discount first to get the present value, and then multiply the time, the second year, right? And finally, we sum all these figures up and divide it by the to the present value, which is 100. Okay. Then we will go ahead with the second scenario. That the bond is based on the fixed annual repayment of the interest and the capital. Firstly, we will, yeah, we will need to know the annual payment, right? Which should be, okay, it's the process is exactly like the scenario one. Yeah, you see, yeah, the the duration and the scenario two is much less than the scenario one. It makes sense because the duration is the weighted average time to receive all cash flows. Whereas the maturity is the date the principal is repaid and the bond stops existing, which is the duration of scenario one likely to be. Let's now move on to the next requirement. The next one is to estimate the impact of the two proposals on how the funds may be used on the next year's forecast earnings, financial position, earnings per share, and gearing. Yeah, it's over here. Estimates. Okay. Let's go over the two proposals first. Yeah, proposal one is buy back equity shares at their current share price, and proposal two is invest in additional assets in new business ventures. Mm, yeah, and both scenarios we will have to take a we will have to take a consideration of interest payable on new bonds of 1,320 million. It's over here. And additional interest payable of existing bond of existing liabilities of 120 million incurred by the new bond as a result of credit rating downgrade. Okay, we have known in the context that the current forecast earnings is 350 million. Let's begin with it. Current forecast. Profit after tax 350. Let's see, proposal one. Proposal two. Firstly, we will consider the new bonds, the interest incurred by the new bonds. It would be yeah, and the yeah, the coupon rate is we have known, we have calculated. Here it's we will need to take the tax shield into consideration, and the tax rate is 15%. So it's like this. Yeah, for both proposals, there's no difference. So, and also we will need to take a consideration of the extra interests for the existing liabilities as a result of the credit rating downgrade from the new bond issuance. Extra interest of existing liabilities. So it's 120. Yeah, it's known there's a 37 base points increase, so it's yeah, and okay. For the proposal 2, because the it will be used to invest with a proper with a return of 12%. So return. So we'll have the adjusted profit after tax. Minus okay. So we have got the adjusted profit after tax. We have taken the relevant factors into consideration. We also required to restructure the financial position. So let's go ahead with it. Yeah, here we go. This is the original forecast financial position for next year. Yeah, and let's copy it to the spreadsheet. So this is the current forecast. We will base all the calculations on the current forecast. For proposal 1, it's to buy back the shares with the new issuance of bond of 1,320 million. So yeah, let's begin with this, because there will be a buyback of shares. So and the share at the current price, which is 11. So there will be a 120 bought back, and so the after the purchase back, the share capital will be 280. Well, since there's a 320 this figure is bought back, so the rest goes to reserves. So the rest of the reserves should be okay. But at the same time, we also need to consider the net loss of proposal 1. So the net loss is okay. And the others, we will go through one by one. The difference for this one, as there's interests paid out, so the current assets will be minus. Okay. Assets. And then current liabilities increased by 1,320. So in total, yeah, it's balanced. So let's see proposal 2. Firstly, non-current liabilities will increase by 1,320. This is the same as the proposal 1. In the meantime, it's invested in a new project, so the non-current assets will also increase by the same amount. Okay. Total assets. the share capitals, no difference. Reserves, because there's a net increase of profit after tax, so the reserves will increase by this amount. Hold up, there's something missed out. We'll find it out. Yeah, we will need to cut this. Yeah, it's now balanced. So by far we have already restructured the financial positions and two proposals. And yeah, we were asked to calculate the gearing. The gearing is the non-current liabilities against the equities. So we see there's a drastic increase of gearing comparing the current forecast with proposal 1 and proposal 2, because obviously there's the new bond issuance of 1,320 million. And also, we were also required to calculate the earnings per share. So we see, and both scenarios, the earnings per share have increased, and the proposal 2 has a better earnings per share than proposal 1. Okay, so far we have finished all the requirement of calculations. Let's check if there's anything skipped off. Yeah, we have got the value of the change in value of the current bond and the coupon rate required for the new bond. Yeah, we have got the Macaulay duration and both scenarios. We have got the forecast earnings, financial position, earnings per share, and gearing, and both scenarios. So that's it. In the beginning, I said I will cover all required questions, but not necessarily following the order. As we have finished all the required calculations, let's go back to the discussion session with calculation results. The reasoning will be more intelligible. Okay. It's requirement A. Discussion the possible reasons for the financial director's suggestion that the company could benefit from the higher level of debt with respect to risk, from protection against acquisition bids, and from tax benefits. In the context, it's over here. Okay, let's break it down into 3 aspects per the requirement. Firstly, risk. The company faces both financial risk and business risk. Normally, the financial risk increases as the debt levels in the capital structure increases. However, it can be argued that in this case, the company's business risk has reduced as its profits and cash flows have been steady. Therefore, in the early life of the company, it cannot bear a high level of financial risk. Now that with the business risk is lower than it was, it can change its capital structure without having a detrimental impact on the overall risk profile. And secondly, from the perspective of protection against acquisition bids, normally the predatory acquisition of one company by another could be undertaken for a number of reasons. One possible reason may be to gain access to cash resources, where a company which needs cash resources may want to take over another company that has significant cash resources or cash generative capability. Another reason may be to increase the debt capacity of the acquirer by using the assets of the targeted company. Where the relevant where the relative level of debt finance is increased in the capital structure of company through a financial reconstruction. These reasons for acquiring a company may be diminished. This is because the increased levels of debt would probably be secured against the assets of the company, and therefore the acquirer cannot use them to raise additional debt finance, and cash resources would be needed to fund the higher interest payments. And thirdly, uh, let's take it from the perspective of tax shields. As many tax jurisdictions worldwide allow that interest to be deducted from profits before the amount of tax payable is calculated on the profits. So, increasing the amount of debt finance will increase the amount of interest paid, reducing the taxable profits and therefore the tax paid. So that's the benefit of tax shield. Mm, so I think by far we have covered uh, the benefits of potential benefits of a higher level of the the debts. In this case, is the new issuance of the bonds of $1,320 million that can bring to the company. Okay, thank you.